Hi guys, thanks for tuning in to another episode of Nuggets News or Trader Talk, and we welcome back our friend Charting Man Dan. How are you, Dan?
Good, Alex. Glad to be back. Thanks for having
And
me.
yeah, thanks for joining us from the other side of the world, where you've got the sun setting in your eyes at the moment, and the sun's just coming up here. But wow, what a day to have a chat! Oil markets crashing. We're going to touch on that. We're going to cover all the major asset classes, and Dan's going to run us through the charts, and we're going to talk about the fundamentals as well. So, a brief overview, maybe Dan, of everything that you're thinking at the moment, watching this unfold.
Sure, there's lots of fear out there. Obviously, there's right now we're looking where is money safe. So I personally have been mostly cash for a long time, and that has kept me pretty confident. And that has I've been fortunate to escape the bloodshed, so to speak. We're almost in a scenario where as long as you're going break even, you're ahead of the game. So I have been looking at places where can we put money. We've been looking at gold that's holding up a little well. People have been looking at crypto. Can Bitcoin hold up in the face of this market weakness? And unfortunately, it hasn't really done a stellar job of doing so, but pretty much trying to avoid the weakness and keep that cash ready to go for when the dip buying opportunity presents itself, because we know when there's maximum fear, there's maximum opportunity at some point as well.
Absolutely, and I know, like personally, I've been pretty defensive in my super account, and just being in bonds has actually ended up being a decent trade as well over the past year or so, and obviously even more so when it all starts to unwind. But I certainly plan on rotating that money back into riskier assets whenever the bottom may be. And the headlines that we're reading, we are now in conditions that are the worst since the GFC, and we know that is going to present opportunity. So do you want to maybe look at the oil market to begin with, Dan? Because I think this is really where it all probably kicked us over the cliff in the past couple of days. We already had the coronavirus in the background and other fears, but it was the oil market that got pretty nasty recently.
Absolutely. So just overnight, over the weekend, things got really extreme as we see the Saudis and Russia having a little bit of a price battle. And it was really just a lack of support under a certain area. The low 42s was a level that was a really key level for us. And then once that broke, it was pretty much, you can see 42, 42, 42. So a base of support down there. Once that broke, it was 39 and then very little down to 26. And you can see how quickly after 42, next thing you know, we're down in the mid 20s. So a temporary bottom has been set. As far as is this the bottom, we need a lot more information. I'm watching the 4-hour time frame currently, where there's tons of range. You know, the low to the high of the bounce, that's a 20% bounce. But we have to see trend changes if we're going to have any confidence that the temporary bottom has been set. And for me, it plays a big factor in equities as well, because we know that they are tied to the hip to a certain degree with correlation. So I have to be confident that an oil bottom is in if I'm going to be confident that an equities bottom is going to be in as
Yeah.
well.
And from the fundamental side of things, I actually probably want to do a full whiteboard video about this because it's pretty complicated and there's a lot going on. But basically, all those OPEC oil producing nations couldn't come to an agreement about how they were going to all take a little sacrifice and cut back production. You know, it becomes this protectionist theme that we've seen in a lot of other sectors. And Donald Trump has gone about this as well, saying, no, you know, we need to look after ourselves. So we're going to pump record amounts of oil because with the lower price of oil per barrel, we need to produce more barrels to get the same amount of revenue. So the Saudis and Russia and those guys that have pretty low cost oil, $25 or less per barrel, they're saying we're just going to pump as much as we can and we're going to put all the US shale producers that have a cost of $30, $40, $50 per barrel out of action. And that has some twofold effects because a lot of those companies have issued their junk bonds and their debt, and they're not going to be able to pay that. So that creates this, I guess, house of cards effect in the US energy sector.
And it's not only the individual companies. You have to consider specifically, I know Canada, this is a big thing, but in the US as well, there are areas that are dependent on the oil economy. So you don't just have the company going under, but you have the company, the town is made up of the oil workers, you have the restaurants and the grocery stores. And if it goes under, then that's how you have desert towns in the middle of, America from industries past over the decades. And it can really have an economic hit that has a lot of ripple effects.
Absolutely. We've seen that in Australia, in Western Australia, property still down 50% or more in some of these towns, as you say, that had mining booms, and then it never quite bounced back. And as an investor, it's important to think about those second or third order effects that Dan just discussed there as well. So maybe let's head over and have a look at the stock market next, Dan.
So I always look at the S&P 500. I like it a bit better than the Dow, just having a broader spectrum of companies to be looking at. But for me, the level of 28.55 was very key, because the whole dump of last week, I was wondering, the question I had is this like December 2018 or is this like 2008? And as soon as you break that low, it starts to shift the most likely scenario to now getting to be more like 2008. Because if you look back historically, all these dumps that we've seen over the last 4 or 5 years have generally V-shaped recoveries, and they do not drop to lower lows. Once they find that little maximum bottom, it's V-shaped recovery. At worst, it's sideways and then bullish continuation. Here's 2018, the end of the year, all-out dump, V-shaped recovery. So this all-out dump, very significant recovery, but then giving it all back is definitely a big red flag for me in terms of this is different. Don't treat this like you have treated the dumps of the past couple of years. Remain more cautious. RSI as an indicator is less reliable, and patience is the key.
Yeah, we've actually got a bit of divergence there at the moment, Dan, but I just think that the same thing that I've been saying for the past couple of weeks or months since this started, that the coronavirus has all the makings, its features, the contagiousness. I think this is going to get worse. And that's the same thing I've been saying for a month or so now. And just today we find out that Italy's gone into lockdown. I think the number of cases that's circulating is a lot higher. If you look at the death rate that's supposedly around 1 or 2%, it's not as bad as the first reported 3 or 4%. If we look at the number of people that are dying and we take that statistic and extrapolate it, that means that we are actually got thousands of people that we don't know about that aren't tested yet, if those numbers are correct. And that means those people are out there in public. And again, it's nothing to worry about. If Dan or I get coronavirus, we're going to be fine. We're probably not even going to get symptoms. But it's those elderly people and the supply chains and the means to quarantine it that is going to slow down the economy. So I just don't see that there's this resolution where we say, oh, this is going to be passed in the next couple of weeks and everything's going to be fine. And that's why I think stock markets are reacting the worst since the GFC, because they're now starting to price in that this could be bad for months.
Yeah, and I think that they will price it in advance, in the sense that I think that the market will bottom from a bit of an overreaction eventually before we say, okay, things are okay. So I think the market will hit that bottom before we are, as a collective, giving the green light and sigh of relief. So certainly something to keep an eye out for. Like you said, there's divergence. After a 7% down day, if we see a gap down open tomorrow, I'm going to start thinking about, 5-10 years out and maybe start nibbling at some slow scale in longer term positions.
I think it's important to put your trader hat on as well, because as you say, you might want to go in and then we get some really bad news over the weekend. You've got to know when to maybe cut your losses. And there's a lot of difference adding to your positions for your retirement portfolio in 10 years than someone just saying, oh, you know what, it's been a couple of big red down days, I'm going to push all my chips back into the market. If you don't know what you're doing and then we fall another 20% over the next month, are you going to panic and then sell at the bottom when there's a lot of blood in the streets? And it probably feels like it's the worst of times ahead, because I agree that markets are going to bottom before the worst of the coronavirus has probably actually unfolded. We know that they're forward-looking, and it doesn't mean that everything is going to be bad. I was talking the other day, what are people going to do if there's a coronavirus outbreak for months? They're going to play computer games. Maybe you look at EA Sports and some of these other stocks. People are going to work from home. Does that mean they're going to be using Zoom or Slack more? These other things. So there's always opportunity, Dan. Money doesn't die and go to money heaven. It rotates into other sectors.
Yeah. Absolutely. And on that note, the tech sector, Netflix has definitely stood out to us, just as far as comparing it to Amazon, Google, everybody else. Netflix is holding on a lot better because people are going to be home watching their movies and TV shows.
Exactly. So maybe if we want to have a look at the bond market next, talking about money rotating, and this, again, was a really good sign as a trader. If you're watching the daily chart of bonds, when the stock market had its bounce and we were saying, I think this is a dead cat bounce, one of those clues was that there's no money rotating out of bonds. All that money was very much staying in that safe haven. So I wasn't buying the bounce. I definitely thought we were going to have that other leg lower. And so far, there's no money coming out of bonds. Money is still going in.
Yeah, it's definitely, like I said, I'm learning about bonds. It's part of my New Year's resolution as a trader for 2020, where this is one of my weak points. I personally have never used the information that the bond charts give us for a trade in my entire life, but I definitely want to have more of a macroeconomic sense of things. And just, looking at the chart, seeing this tightening range with a clear bull break, increasing bull volume, and then just a runaway bull move. We know there's going to be daily consolidation likely in the near term future, but plenty of space to keep strength in the uptrend with where we currently stand.
Bonds was something that took me years to grasp. And I think it's because you hear about the yield on a bond and then the price of a bond, and sometimes they're inversely correlated. The easiest way for people at home or yourself, Dan, I think about it as a government savings account. If I know that I can get 1% in the government bank, and they're never going to default because they can always print more money, all these stock guys are just rotating into this savings account, the government savings account, where they can get 1%, and they don't want to risk having money in any other risky sectors. So that's my definition of bonds.
Makes sense.
What have we got next, Dan? You want to look at dollars or gold?
Let's look at gold. So I have been long gold via GLD for about 2 months at this point. And it was the kind of thing where I was constantly saying, okay, the S&P 500 is at all-time highs. The dollar is extremely strong, and gold is trading sideways. That's ideal scenario because we know any market weakness, any dollar weakness, gold is just ready to go. And that worked twice on the way up with my initial entry in December, and then again here as we plateaued a little bit. But now we're in the opposite scenario. So today, gold did go a little bit higher, nothing extreme, but I got to the point where I'm saying, okay, the market is down 7%. The dollar is dumping and at daily RSI of 20 and extremely oversold. If we're not going up significantly on a day like today, we're pretty much just waiting for short-term bounces in the dollar and the market to pull back in gold. So I did exit half of my GLD long-term position today just because it's the complete opposite scenario of why I initially entered bullish, seeing that play out now for the potential that we might see a bit of consolidation.
And I think there's some interesting aspects of the gold market. We saw you've got that big red candle there, and that was that initial liquidity event when everything sells off, and people, traders that are getting margin calls, have to sell anything that's fairly liquid. And the gold market, the bond markets, these are the most traded markets in the world. But then from that, we got a really strong rebound, and it basically got it all back within the next day or two, that nice reversal candlestick pattern there. So I think gold's kind of in the midst of this time when people know that gold's probably going to react strongly after whatever happens, after the initial crunch, because central banks are going to have to print a lot of money. Nothing's been fixed since the GFC, and we saw that gold went on that multi-year bull market after the last GFC. So I think people are kind of happy to buy any dips, and this selling can just be those liquidity events. It's possibly a similar circumstance for Bitcoin, which we'll get to in just a second. But if you want to bring up XAU, AUD down, have a look at the Aussie dollar gold price, you can see just about every country in the world is in record highs. I think gold hit $2,700 an ounce yesterday in Australia.
Yeah, big upper wick, but those upper wicks recover. Like you said, the bulls do buy the dips that result. Those upper wicks have been notable for marking temporary tops, but usually a solid recovery to higher highs.
All right, so I think Bitcoin finally, Dan, and this I was saying similar to gold, where it just Bitcoin, every time I've wanted it to sort of shine and do its own thing and thought, oh, geez, it's breaking the correlation here. It had a bit of a bounce when stocks continued to bleed, and then it just dumps when stocks dump. So I wish Bitcoin could do its own thing, but at the moment it's acting like a risk asset.
Yeah, it's still following the broader monthly equilibrium that we've been keeping an eye on, just the long-term tightening range, higher low of 64.30, lower high of 10,500. So I am looking for a monthly higher low to form, and I am establishing a longer-term position scaling in here based off of this support. That will be my stop level, and hoping that we can see some bullish action into the halving and a bull break of this tightening monthly range. So I'm not letting that discourage me, but definitely is a part of the narrative that specifically crypto Twitter has been all over. And like you said, here's their moment to shine, and we're not really seeing it act in the way that people would hope that it would have.
And again, this is all day-to-day price action that we're describing. So if Bitcoin bottoms, let's say today or tomorrow, and stocks continue to slowly bleed out and Bitcoin continues to creep higher, and then into the halving, it does have its bull run, then we'll look back and say, yeah, it had a few bad days, but it's actually, it's similar to gold. It's sold off in some nasty sell-off days, but now it's doing its own thing, and that's when the narrative can change around Bitcoin. But maybe I'm being a bit hopeful. I think we just have to be honest that if we're heading into this really nasty global event, the chances are that people aren't going to be having these excess money and speculating, and new people are coming into investing in assets in general. We've just got to be cognizant of all those themes playing out.
Absolutely. We always got to avoid groupthink to not get us in trouble.
Is there anything else, Dan? You mentioned Netflix. Anything else that's taken your interest, or just in general, of stocks that have held up well or worse than you would have thought?
There's a handful of stocks. I mean, Walmart is holding up really well. We've got Costco holding up well. So again, those names that are going to potentially benefit a bit by people, pinching their wallets and not spending as much if things tighten up. And they are seeing the ability to hold up better currently at this point. So there are names holding up a lot better. There are names holding up a lot worse. And I personally will be keeping an eye on the names holding up better, obviously, for when we do see some temporary relief from the market, because those are the names that are going to be positioned best to head back towards recent highs sooner.
Absolutely. And I guess finally, Dan, I want to put our prepper hats on. So not your tinfoil hat, just your prepper hat. And I know you did a video about this a little while ago, and we're pretty lucky. I know you live out of the way a little bit, and I'm down in Tasmania, where we've got plenty of fresh food and our markets and whatnot. But lately we've seen this run to toilet paper. So there's no TP ETF. But what do you make of all this, and what are your thoughts as someone that has sort of, I guess, prepped a little bit in the past?
It's fascinating, as always. Again, part of why I like markets and technical analysis is the psychology. And then you see these events happen and you're witnessing the psychology of people. Number one, I would say get a bidet. So toilet paper is not a big deal whatsoever. Yeah. But aside from that, it's fear. It's people getting scared. And it's interesting to see how they get scared as a herd. And then again, I feel like it's just magnified by the media to a certain degree, where they show people rushing to get toilet paper. So people are going to rush out to get toilet paper. And as a result of that, so it's almost like this self-fulfilling prophecy. But in the end, all you need to do, in my opinion, is take care of yourself. And if you are living in a city and you're around a ton of people and you are reliant on, having to go out a lot, it's a little bit more scary than if you are set back and have a month's worth of food in your basement. And there's all different ways that we can prepare. In the end, like you said, if you or I or healthy people get this, for the most part, we don't have to worry about it. That doesn't mean walk around like nothing's happening, because then we're putting other people at risk. And that's the last thing we want to be doing. Oh, I'm going to be fine, so I'm going to go travel around. No, you have to be cautious of people that have pre-existing conditions and things like that. So just being aware of things. I always, in the conversations I'm having with people, if someone is maximum fear prepper, worst case scenario, I'm pointing out the good things. I'm pointing out, well, maybe there's a little progress on this vaccine or things like that. And if someone's like, this is no big deal, I'm pointing out the reasons why, hey, this is different than the flu, and maybe it is a big deal. So I always try and be that bit of a balance, because it's important to stay level-headed and think about all scenarios, because how this is going to turn out, we have no idea. We know most likely scenarios, but it's important to look at all areas of the spectrum of what we could be in for.
Exactly. And spectrum is the right word. I mean, when I share stuff on my personal Facebook or on Twitter, you see those people that are, as you say, full on, oh, there's nothing wrong, stop adding to the fear. And then there's the other people that are saying, this is the worst thing ever, everyone's going to die. It's like, well, no, most people are going to be fine, but we've got to help prevent those people that are immunosuppressed and elderly and that as well. So I think that's been a great chat, Dan. Any final topics for people at home?
No, I would say use this time, if you're staying home, to educate yourself, watch some YouTube videos, and be productive.
And even if you're sitting there and thinking, I just wish I knew more, I'm not a trader, this, that, or the other, if you're our age or even older, there's probably going to be these events every 10, 20 years or so. So even if you don't make any trades this time around and you have a practice account and you learn how to rotate from gold to bonds to stocks, that is why I always say that these are lifelong skills, because if we have another event in 10 years time and you have learned how to protect your money and whatnot, and then you retire after the following crisis, you're going to be patting yourself on the back.
Absolutely.
Awesome. Well, thanks for tuning in, guys. Thanks so much for your chat, Dan, and we'll have to do it again soon.
See you next time.